in total home sales in 2012 than we saw in 2010 and the first 2 quarters of 2011. Yes, the rules have changed, and we've all heard stories of documentation nightmares. Many of you have had clients who have gone down this road. Some customers may feel like their mortgage banker is giving them more a personal exam than their physician. Sometimes we bankers feel the same way. I will tell you that there are no current plans to start requiring blood samples at this time. However, I must tell you that a lot of those rules are simply falling back to guidelines that we once used throughout our industry. I think many would agree the guidelines became too loose in the mid-2000s. Unfortunately, in 2007 and 2008, as a reaction to what was happening within the real estate markets, the pendulum swung too far in credit tightening. As you can see here in this history of loans bought by Fannie Mae from 2001 to the present, the credit score bands and loan-to-value ratios have gotten progressively tighter from 2007 forward. I've highlighted the most telling statistic on this page. Note the percentage of loans with credit scores above 740. In 2009, 74% of all loans bought by Fannie Mae had credit scores above 740. From 2001 to 2004, only 41% had credit scores above 740. The next slide shows the Fannie Mae default rate for mortgage loans made in 2008. The default rate is at approximately 1.75%, which is significantly lower than the 7% rates of 2006 and 2007. The 2008 numbers are right in line with historical numbers and are only slightly higher than loans originated from 2000 to 2004. 1.75% is considered an acceptable default rate within our industry. The more telling number is the bright green line, which represents loans originated in 2009. The default rate for these loans is currently close to 0%. I will say typically when we study default rates on mortgage loans, we want to have at least a 3-year history. However, as we move into 2012, if we see the default rates of 2009 stay below 1%, then that will be the clearest sign that credit restrictions are too tight. Fortunately, we have started to see the credit restrictions start to ease back some. Private mortgage insurance companies are now lending up to 90% on second homes. They have lowered their credit score bands to 660. FHA allows even lower credit scores, and owner-occupied condo loans can be purchased at 95% loan-to-value. There are even a handful of banks in our local market making construction permanent loans. All of these are positive signs that the credit markets are easing somewhat.